What's up, everybody? So today I'm going to make a video. I posted in staff notes if you guys wanted a more advanced option strategy video sort of explaining these different advanced strategies and how you can make adjustments to them. And I'm also going to go over the risks with spreads because there are some risks that I didn't go over in the past because I was really just doing them in the 1K challenge, and the risks aren't involved if you close the position out before they expire, which I have been doing and which I do plan on continue to do. But if you guys are playing spreads on your own, it's really important to understand the risks behind that. So I sort of have everything written out here, a summary, and I'm going to go over it all. So really 3 sections to this video: understanding the risks with spreads, explaining the advanced option strategies, and then explaining some adjustments you can do to these strategies once you understand them. I'm going to show the examples. I can show like the P&L percentage and how they're formatted on Tastyworks right here, because it's easiest to do that on here. And then I can show how to make the adjustments on Thinkorswim because it's you can't show the adjustments on Tastyworks. Thinkorswim's really good with that. So I'm going to go and do that. But first I really want to go over this first part, and that's understanding the risks with spreads. It's important to understand these before you make your own plays or even playing them in general. So I'm going to quickly go over this. So before you play spreads, you should learn about assignment and option exercise, because really that's what spreads revolve around, especially when you're shorting premium, which you do with spreads. To play it safe, always close them out before expiration, and I'm going to explain why. So traders have until 5:30 p.m. Eastern time to exercise option contracts. A lot of people get that confused right when the market closes. They think that their option is done with. You actually have an hour and a half later to exercise your option, to contact your broker and do that. If you have a spread expiring out the money and the stock makes a move to put the spread in the money after hours, you will almost always be exercised on your option contract. This is because the option was out the money or worthless, and then went in the money, which gained extrinsic value. So it would only make sense for the trader or investor to exercise it. I'm going to explain that more down below. Again, this can sound pretty confusing, especially if you don't know extrinsic value, but that basically means it gained value from going in the money. When an option is in the money, if an option is $5 in the money, it's always going to be worth $500 minimum. If it's before expiration, it's going to be worth more, and that's because it has intrinsic value on it. So which is time premium built in. So for example, say you sold a 130, 129 put credit spread on Apple, and on expiration day Apple is closing at 133, making your credit spread expire for max profit, and the trader on the other side will receive a max loss. Now say some news comes out after hours that causes Apple to drop 5 points. Apple is now at 128. The trader's 130 put went from worthless to gaining $2 in extrinsic value, or $200. This is because when you exercise a long put, you are selling 100 shares at the strike price you bought it at. When you are short a put, you are buying 100 shares at the strike price you sold it at. In this case, it will only make sense for the buyer of the put to exercise his option, because he can sell 100 shares at Apple at $130 and buy them back immediately at 128, giving him a $200 profit. On the other hand, you will be obligated to buy 100 shares of Apple at 130 when Apple is trading at 128. This will net you a $200 loss. This is why you should always close spreads out before expiration to play it safe. So to summarize this, again, it's really important to understand how option exercise and what happens when options expire worthless. But basically, when you are short premium, or when you're short an option contract, or more specifically when you're short a put anyway, you are making an obligation to go long 100 shares per put contract at the strike price you sold it at, if the buyer chooses to exercise his contract. Right here, the smart thing to do was for the buyer to exercise it, and it only makes sense because the buyer on the other side of your contract, his put expired worthless because it closed out the money. It was worth $0, and he lost all of the premium he paid for it. You can think about this in your scenario. I'm sure all of you guys have at one point or another held an option to expiration, or holding an option to expiration which made it expire worthless, and you lost the full value. Now the thing is, if the stock drops and now the option goes in the money at expiration, that option went from worthless to gaining value due to it being in the money. In this case, $2 in the money, which means it went from worthless to $200. At that point, it only makes, and the only way you can gain that $200 is if the trader exercises that option at that point, because it has expired. You cannot sell it and the market is closed. Therefore, the only way to gain the $200 of value, the trader has to sell or exercise that option, which means they're going long, or no, they're selling their shares at 100 shares at $130 and buying them back at 128. You on the opposite side of the trade have to buy 130 shares, or buy 100 shares at $130, and then the market is trading at 128, which means you are left with an unrealized gain of $200 at the time. At that point, depending on how big your account is, I'm going to go down over here. Either your brokerage will automatically liquidate your position, giving you an immediate loss of $200, or you can hold on to those shares if you'd like. Now down here, while $200 is not a lot, the same thing can happen while playing 5 lots on a more volatile stock like Tesla. Say you had 5 credit spreads open and Tesla dropped $50 under your short strike after hours. Your short strike will get exercised, netting your short 500 shares $50 above the market price. You won't be able to hold the shares either unless you have a large account, because your brokerage will see you are too over leveraged. This will liquidate the position netting you a negative $25,000 loss. So this is a more extreme example. Actually, there was somebody, saw a video that had a $30,000 loss doing this on Tesla. Just $1 wide put credit spreads. It was a super conservative play where they expired out of the money and then Tesla dumped after hours for whatever reason. Could have been like the offering or something like that, and basically the market opened up like down $60 from that short strike, and at the time he got exercised on his short strikes, five lots, opened down $60 lower, and he lost $30,000. His brokerage also automatically sold his shares, giving him a realized loss, which is even worse. He couldn't hold on the shares for them to go back up. He was at market open. He was immediately forced to sell those shares, making it so he lost $30,000 just by putting on a trade that theoretically could have only lost $500. Long story short, to play it super safe, and if you're not super experienced, always close your option or your spreads out before expiration, even if you're missing out on a few dollars, because you don't truly gain the full value of your spread until they expire. So say you're missing out on $3 or $4, even if it's the same day, just close it out. It's not worth it. With that being said, and now explaining the risks behind all of these spreads, this is why in the 1K challenge I've always been closing them out before expiration. And if you make your own plays, I suggest doing the same. Now we can get into the more advanced strategies, or for this video anyway, the butterfly spreads. And super quick, before I go over the butterfly spreads, you first must understand credit and debit spreads. I made a video and it's pinned in the 1K challenge if you want to check that out. That goes over credit spreads, debit spreads, and even iron condors. But all option strategies are built from credit and or debit spreads. They're the building blocks or cornerstones to more advanced strategies. So these wouldn't make sense if you don't understand those first. I made a video on that explaining those going into depth, so I'm not going to go over them today. But now going over the butterfly, this is where I can pull up Tastyworks to show you. But for a regular butterfly, I'm going to go over it quickly and then I'll show you. The format is long one option, short twice as many, and then long another. You are paying a debit for this. This is more so a neutral trade. You are betting the stock will close or trade between a certain range. Depending how you play this, you can bet it will close between where the stock is trading now, which would be a neutral strategy, or you can get more aggressive and play an out the money butterfly spread and bet it will close between a certain price target you have set. Since you are paying a debit, data is working against you. You are long volatility and you can generate a high ROI, but it is a low probability trade. The further you go out the money, the higher probability or the higher ROI you can receive, but it is a lower probability trade. Ideal environment for these trades are low volatility environments where you're betting really on either a directional movement if you're playing out the money, or it can be more so a neutral trade. I would only put this on for a neutral movement, sort of like the stock consolidating, but in a very low volatility environment, you know, a stock that has between like a 10 and 15% IV percentile. And that's because you're long volatility. So you don't want to do it when volatility is high. You make money when volatility goes up, and you lose money when it goes down. So you want to do it when volatility is at its lowest. Pulling up Tastyworks, I can show how to do this right now. And it's pretty simple right here on the long put. This is basically a floor map right here. So you see you're short twice as many strikes as you're long, or you're short twice as many options as you are long. As you see, you're long one, long another, and in between you're short two. Now with the butterfly, it needs to be an equal distance on each strike, which means if I move this strike 2 out, I will move this strike 2 out. As you can see, this will be the max profit and max loss down here. And as you can see, you're paying a debit. So since you are paying a debit, your max loss is going to be the amount you paid. If I want to move this out, I can do that here. Obviously, the farther you move the strikes out, the higher probability trade you have, because your goal is you want the stock to close in between this range. Now, the downside is you're risking more money, as you can see down here. So as the max loss is going to be the debit you're paying, and your max profit is going to be the width of the strikes minus the debit you are paying. So in this case, if I'm paying 17 debit, now it says 19, 17, your max profit is going to be 100 because it's a $1 wide spread minus 17, which is 83. Make it $3 wide, and you're now paying 138 to make 158. So again, higher ROI, you can make over 100%. And pulling up the analysis tab right here, this is what the P&L would look like. Let me make this a bit bigger. So you can see max loss is 100. Like, I mean, it keeps changing here. I could set this at a set price. Put that like 139. Max loss will be 139. 139 on either side, and then once it comes in between those short strikes, you're going to start making money once it's inside those strikes right here, plus the debit you're paying. So it's the 366 plus the 139. You'll start making money around that area of 367.39, and then save them over here, 370.61. And once it gets to the short strikes, we're short the 369 puts. That's when you make the most money, once it's trading around that 369 area. So again, a neutral strategy, you wanted to trade here, or like I said, you can go farther out the money, generate a higher ROI, and be more aggressive about it. So say I think SPY is going to close between 350, 363, and 367. Okay, it's not a bad bet, but you can actually risk $14 to make 185 or 186. That's more than 1,000% right there. So like, and that's if you get the max gain if SPY closes around 365. So again, you can make over 1,000% betting SPY will close between a range that isn't even bad. In my opinion, this is a lot better than naked options. And it can generate a crazy return on investment. Again, you can see it here on the P&L diagram. Risking only 15 if it closes above or below the long strikes. If it closes below 363 or below above 367, you'll lose the money. If it closes in between, depending on how close it closes to that short strikes of 365, you can make up to $187 on this trade. So that's how you're going to do it. Again, the further the strike width, the higher probability you have, the larger range, but at the same time, the more you're going to pay. I can make this $1 wide, and I can only risk $2 to make $98. And that's betting SPY will close between 366 and 364. Again, like, not even a bad bet. This expires tomorrow. In a 2-point range, if you're only risking $2 to make 98, it's not bad at all. If you wanted like a little lotto, you don't have to be paying, you know, $30 for weeklies when you can do something like this, where you limit your risk. So that's a butterfly. I can go farther out. The farther expiration, the more they're going to cost, because the more time you have, just like any option. So you can see I can go to a 360, 363. I can't do that. They've got to be equal. 360, 362, 364. Again, and on SPY, this is 23 days until expiration. And I mean, like, you're only risking $6 to make 194. Yeah, which is kind of crazy. $1 to make 99. You can go more so at the money, risk 4 to make 96. So again, the advantage to this is a crazy return on investment for something that is actually at the money and has a higher probability, in my opinion, of playing out. Has a lot lower break-even price than if you were to play naked options. That's why the butterfly is great. Now, going on to the broken wing butterfly. The format is the same as a regular butterfly, except you move the far out the money strike or long strike out a bit to receive a credit. You are receiving a credit for this. Since you are receiving a credit, this trade has a higher probability of being profitable and you can win a lot more ways. If you play a put broken wing butterfly, you have no risk to the upside, no risk if it consolidates, and the stock can even go down a bit and you can make even more money if played correctly. If you play call broken wing butterfly, you have no risk to the downside, no risk if it consolidates, and the stock can even go up a bit and you can make even more money if played correctly. Think of it as a credit spread with a built-in lottery ticket. It's like your normal credit spread. You receive, say, $50, risking $200. The fun part is that if the stock closes between a certain range, you can actually make up to, say, $250 in profit, which would be a 125% return on investment, which you never really see while selling premium. So this personally is my favorite advanced option strategy, and that's just because there's so many ways you can win on this while still getting like a crazy return on investment. Again, you really need to understand credit spreads for this because you are receiving a credit. I could just quickly show a credit spread right here, but you would be selling, say, like the 365 strike, buying the 364, betting SPY will close above 365 by expiration. Again, the stock can go up, you'll make money. The stock can stay sideways, you're going to make money because it's still above 365, and the stock can even go down a bit. I'll even show you here, the stock can go down to about 364.73. And you're gonna make money. So, and that's because you're really betting it's gonna stay. You'll make max profit if it closes above 365. You'll lose your max loss if it closes below 364. So again, high probability trade right here. As you can see, 77% chance of hitting 50%, 57% chance of being profitable. But the thing is, you're risking $73 to make 27, which is it's comes with high probability trades, but you're risking a lot to make a little. The thing with the broken wing butterfly is there is a certain range, like I said, that has a built-in lottery ticket where you can actually make a large return on investment, especially for selling premium. And basically the format is going to be a regular butterfly like this, except you're going to bring out the far out the money strike to receive a credit down here like this. They're not going to be equal to each other. So for this trade right here, I'll bring it right here. You can see this is basically a 367, 369, 370 broken wing butterfly on the put side. This would be betting you're going to receive a $30 credit. Your max profit's 130, and you're risking. This keeps changing. Let me move this here. So say you're 30. So max credit can be $30 if all strikes close out of the money and expire worthless. That means if the stock closes above 370, you will receive $30. Your max profit's $130, which I'll go over, and your max loss is $70. If the stock closes at 369 by expiration, you'll make $130. And that's by selling premium, which is crazy, while only risking 70. If the stock closes below 367, you're going to receive that max loss of $70. So this trade has, and this is a more aggressive one, so it has unlimited upside potential, as in no upside risk. The stock can go to 400 and you're going to make $30. The stock can go to 369 or a little below and a little above, and you're going to make even more, between 100 and 130. And the stock can close below 367 and you'll lose 70. I'll show you right here. Let me just make sure it's correct. Yeah. So this is what it's going to look like. As you can see, the stock can close anywhere above, if I can zoom out a bit. The stock can literally close at 420. You're going to make $30 no matter how high the stock goes. Now, the lottery ticket comes in if the stock closes between 368 and 370. You can make up to $130, and if the stock closes below 367, you're going to receive your max loss. around 367.5. That's the point where you're going to have to take your max profit, $130, and subtract it from your short strike, and that's where you get your break-even price, which is coming in around 367.7. And that's because you're selling the 369 puts, 130 profit, 369 minus 1.3 is going to be 367.7. Max loss is coming in at $70, which is below the 367 strike. And so you can make these high probability trades. I'm going to show example, but it's really great to do these out of the money like this. You're going to be, if the stock closes above 363, keep in mind it's trading at 368, you are risking $82 to make $19 in credit if it closes above 363. But say the stock comes down a little bit. So this is technically a bullish trade because there is unlimited risk to the upside, or no risk to the upside, sorry. You can make $20 no matter how high it goes. But if the stock trades, consolidates or even comes down a bit between that 363 to 360 range, you can make up to $120 risking 80, which is insane. So there's that right there. And yeah, so that's really the broken wing butterfly. I'm going to show some examples, and I'm going to talk about the adjustments you can make. So the broken wing butterfly adjustment. One of the great things about advanced option strategies are the adjustments you can make for them to work in your favor. You can make an adjustment to make a broken wing butterfly risk-free, so the worst case scenario is that you make money. You must first truly understand how broken wing butterflies and debit spreads work first, or else this won't make sense. Once a broken wing butterfly is up a decent amount, you can buy an embedded debit spread inside of the broken wing butterfly to make it risk-free. By buying the embedded debit spread, you are turning the broken wing butterfly into a regular butterfly with no downside risk. With this being said, the debit spread must be short the far out the money strike and long the strike that is in equal distance from the other long strike. This is how you form a butterfly spread. I just showed you before, for the butterfly spread with the debit, you need the strikes to be equal to each other. Basically, we're taking the broken wing butterfly and we are turning it into a regular butterfly by closing out the far out the money spread, or the far out the money strike that is farther away from the other strike, and then we're going to be selling the strike price that is equal to the other strike distance. So I'm going to go over this a bit more, but I'll just show you quickly. We'll put back on this butterfly. To make this adjustment, you can see what we would do. So this strike is 2 out, this one is 4 out. We're going to close out, we're going to open a debit spread by closing out the 365 strike, so selling this, and we're going to be buying the 367 strike because that is 2 strikes away from the short strike, just like the 371 is. So basically we'll be turning it into something that looks like this, into something that looks like this. So that's really what it would look like. So this is how you form a butterfly. The catch is the debit you are paying must be less than the credit you received for the butterfly. This is how you make it risk-free. I'm going to go over this for you. Say you receive $1 credit for putting on the broken wing butterfly. If you are able to buy the debit spread to turn it into a regular butterfly for $40, this means in the worst case scenario you will make $60 on the trade. The best case scenario, the butterfly ends up trading near the lottery strike price and you can make up to $300 on the trade hypothetically. Like every option adjustment, there is a downside, and that is that you will be limiting your profit potential on the credit side. While in that example above, the least you can make is $60. If all strikes expire out the money, the most you can make is $60 now too. That $100 credit is now out of the picture. The only way you receive more than $60 is if the stock is trading near your short strikes, which in this example can make up to $300 hypothetically. As an example, I did this week with a weekly QQQ broken wing butterfly. I opened 2 lots of a broken wing butterfly for $12 credit each, netting me $24 credit if all strikes expire out the money. I think max gain is around 260 and my max loss is around 350. If QQQ trades near my short strike by expiration, it expires tomorrow. And that is if QQQ trades near my short strikes by expiration. So if it trades near the short strikes, I'll receive that $350. On Monday, volatility shot up on the gap down we had. Once I put the broken wing butterfly spread on, I'm now short Vega, which means I'm looking for contraction in implied volatility. And this is exactly what happened, which caused the spread to be up more than 60% in one day. Since I was up a large percentage in one day, I still had a few days on. I didn't want to leave all this risk on the table, so I decided to turn it into the risk-free butterfly spread. Because I don't want to leave that $350 of risk, especially in one day if I'm up 60%. So I did this by closing out the far out the money strike and buying a strike that is equal distance away from the short strike as the other strike. I did this for a $7 debit, which was $5 less than the credit I received. Since I had 2 lots on, this mean in the worst case scenario I make $10 on this trade. Best case I make about $260. The downside is that I won't be able to receive the full $24 of credit if all strikes expire out the money. I will only be able to receive $10. Personally, I think the extra $12, leaving the extra $12 on the table to take off about $207 in risk if the stock dumps is worth it. And actually, you're taking out about, this is wrong, about $360 in risk, because I was up $10 and my max loss is about $350. Theoretically, I only had $12 left to make, and at that point I'm risking $360. So it's best to take off all the risk, even if you're limiting your upside potential on this. I'd rather just take off all that risk. I'm going to show how to make that adjustment. So like I showed you right here, and I'm going to show it on Thinkorswim, by the way, but quickly you're going to go put on a butterfly just like this, broken wing butterfly like this. We're going to be closing out this long strike and opening a short strike that is less than the credit received. So receiving 31 credit right here, for example, or I'll go here 30 just because put it at a limit so it won't change. $30 credit. The only way we want to do this is if we're receiving less, or if we're paying less than a $30 debit to close out this strike and open up this strike. For that to happen, the trade already has to be up a good amount. And depending on how much you're paying is how much you will make if all strikes expire out the money. So say I'm receiving a 30 credit and now I'm opening this up right here. I'll show the adjustment. It's showing 34. I would need to open this up for say $20 to receive $10 max. Let's go on Thinkorswim and I'm going to show you exactly how to do that. So I'll show you with a trade that I already have on. So right here, I have 2 weekly trades on right now. Now the QQQ one is the one I made risk-free, which means the most I can make now is $10 on this trade. And the SPY one, I have two different SPY weeklies, or not 2 different SPY weeklies. I have 1 weekly on and then 1 2 weeks out, but it's basically the max profit. And I'm going to pull up the diagram. I can show you on the... So first up, this is an example of the QQQ one, really quickly. So as you can see, I opened the QQQ broken wing butterfly for $12 credit, and then I later bought back the spread for $7 debit. Meaning that my max gain, I had 2 lots on, it was $5 per lot, $10. With a max potential gain of I can see if I go to analyze trade, just make sure. I had a max profit of around 200 something up there. So now if we go back to the SPY one, I'm going to show you really quickly. And this was something else right here. We received an $87 credit for this. So I'm going to go to analyze trade. So right here, this is the trade right here. So max gain was $87. Max loss is about $313. And max profit is coming in around like $285, $286. Now, what I would do here to make this risk-free, and if I wanted to make this risk-free, I could right now. I would go here. So we have this on in the Analyze tab. I'm going to see that this is 2 strike without, so I'm going to go 364, 363, 362, buy a vertical, and then I'm going to go to the 358 strike, and that's $5. So I could bring this here. Alright, so I can put this on here, put this at 1, and this is exactly what it would look like here. The adjustment made, where my max profit would now be, or my least amount of profit would be $82. Stock can go anywhere. Stock can go down to 290. Stock can go up to 400, and I'm going to make $82. And that's because I received $87 credit, and I'm buying back a vertical spread for $5, making this into a regular butterfly spread where my max or my least amount of money I can make is $82, and my max profit is going to be up there somewhere near that 226 to 80 area, I think. So that's really how you do it. And there's not much else to say, but that's how you turn a broken wing butterfly into a risk-free butterfly spread, just like that. And yeah, no, that's really about it. So if you guys have any questions, please let me know. And yeah, just reach out. I know these can be pretty confusing, so I'm happy to answer any questions you have about spreads.